This is the current federal tax developments for the week of December 29, 2025. Current federal tax developments are brought to you by our state society of CPAs. I'm Ed Zollers, coming to you here from Phoenix, and let's take a look at what's going on in this week's developments. Well, I want to welcome you back to what is a short week, assuming you're doing anything this week related to taxes. I think most of us unfortunately get dragged down during this week because there is this unfortunate December 31st date that arrives. That is the end of the tax planning season that we tend to be around for. So even if the rest of the world doesn't seem to be where you're at today, you look outside, you see less traffic, etc. A lot of us are stuck down in the office for this week, at least until the 31st. So if you're down there doing that, welcome back for this week. At least it's only 3 days. And we will then see how the rest of the tax season goes. But this week, and again, it's been kind of a short week because things don't happen a lot here right at the end of the year. But we did want to talk about the executive action that we got on marijuana scheduling or rescheduling and how that impacts Internal Revenue Code Section 280E. The point right now is the answer is nothing at the moment. But we'll talk a bit about what could happen to us on the tax side with that. This is one of those things that a year ago we were talking about as being a thing that was on the table, and then we've ignored it for the year, and now we're back apparently paying attention to it again. We're also going to talk about some additional relief granted for state paid family and medical leave programs. The IRS dealt with that early in 2025, gave us some guidance and gave us a 1-year relief. We're going to get partial additional relief for 1 more year or continued relief for 1 more year, but it's only partial. So we need to talk about what parts didn't get extended. We also had the IRS deal with a glitch in the new tax bill. And granted estimated tax payment relief for qualified farmland sales because, as drafted, it would have required an absurd estimated tax payment amount if you actually are one of those few people that have qualified farmland sales and you're deferring paying 3/4 of the tax on that. Without this, in theory, you'd be penalized for underpayment of estimated taxes if you didn't pay in 100% of the tax. So the IRS now has solved that problem administratively. We also have 2 new fact sheets that deal with law changes that took place. One's going to talk about 163J and the business interest limitations and what's different about those for this year. As well, we're going to talk about the changes in the premium tax credit revisions, which is a change that has been scheduled in the law for quite a while. And there's been a lot of talk about potentially changing the change and going back to some form of what we had before, or some variant, or some different thing, or we don't know what we're doing. But if nothing happens, we're going to talk about what the premium tax credit looks like for 26, because the rubber is meeting the road. Congress is out of session through the end of the year. On January 1st of 2026, we go to the old version that was in the Affordable Care Act and not the version we got during the pandemic. So we'll talk about where we stand and some of the things happening with that. But let's talk about first the executive order that related to marijuana scheduling in Section 280E that was entitled Increasing Medical Marijuana and Cannabis Research. Now, the key issue with this is a potential sunset of the effectiveness of IRC Section 280 Cap E as it relates to cannabis businesses. And that's really the big takeaway for us in tax and why in tax we're interested in this. So it could have a very, very significant impact on any cannabis businesses and their taxation. Let's say a massive impact is the best way to phrase it. So this order issued December 18th doesn't really do anything yet. But what it does do is basically speed up the process that's been on hold since last December regarding this proposed rescheduling of marijuana and cannabis information. So the order was issued, as noted, on the 18th of December, and it's distinct because it moves beyond a policy statement to some very specific directives. Section 2A of the order explicitly orders the Attorney General to complete the rulemaking process to reschedule marijuana in the most expeditious manner, is the term used. We get to talk a little fancy in executive orders, so that's the idea there. So what's happening here is the orders coming from on high, executive orders are issued by the president, is telling the Department of Justice to essentially cut through the red tape, finish the job that was started in 2024. And the urgency level suggests we may see some relief on this sooner rather than later. Still speculative, because as it is right now, in one sense, nothing changed. We're still where we were the day before with regard to 280 Cap E still applies at the moment. We just have to see how it's going to go forward. So again, basically finishing up the rulemaking, but until it's finished, it's got to be finished. So to quote Yogi Berra, it's never over till it's over. So until we actually get those final rules, we have to remember nothing's happened. Now, to understand where we are, you got to look back to how we got there and where it started. Back in May of 2024, the Department of Justice and the Drug Enforcement Administration issued a notice of proposed rulemaking. That notice of proposed rulemaking would have rescheduled marijuana from Schedule 1 to Schedule 3. Now, that proposal is currently stuck in the administrative law hearing phase after having received nearly 43,000 public comments. The regulations were not finalized before the end of the prior administration, and therefore, were basically handed off to the current administration, and nothing really happened with them in the interim. But the move to Schedule 3 was backed by a Health and Human Services finding that marijuana has a currently accepted medical use and lower abuse potentials than Schedule 1 or 2 drugs. And that finding is essentially what this is being based on. In essence, there is no current challenge, at least from the White House, to the finding that there is a potential medical use. And if you read the exempt order, it's not telling you a whole lot about any tax side of this, of how this would work. It's totally emphasizing the ability to open up medical research and open up medical uses. That's kind of the area that the concentration is coming from right now from the White House. But there is a tax problem here, because their quick refresher, if you don't understand why it matters what schedule marijuana is on, the reason is because Section 280E of the Internal Revenue Code effectively blocks all deductions for a trade or business that consists of trafficking in controlled substances within the meaning of Schedules 1 and 3, or 1 and 2, I should say, not 3, right? So what that means is the only deduction a cannabis business gets is for cost of goods sold and cost of goods actually sold. Inventory shrinkage is not technically a deduction, right? If it's stolen, or even if we had a ruling that was seized by the Department of Justice in a raid, that's not deductible. You have to actually sell it. But if you sell it, that's a deduction. Now, that has a huge impact on retail marijuana sales for obvious reasons, because retailers don't capitalize a whole lot. Producers capitalize a whole lot more. But the other thing to remember about producers is under rulings, and basically the whole section of the UNICAP rules under 280 Cap A told us that you cannot capitalize something under 280 Cap A, throw into inventory, under the UNICAP rules. Now, under the regular 280A capitalization, little a, these references aren't confusing at all, I know. But on 280 little a capitalization and 474 for inventory, the general rules, you can capitalize these items, but you can't capitalize items that would not be deductible if 280 Cap A hadn't existed. And therefore, we don't really use UNICAP. Now, remember, this issue exists because of 280 Cap E. And keep the UNICAP part of this in mind, because I think a lot of people are going to miss the fact that if it is rescheduled, UNICAP is going to apply to these businesses instantly as well. So you have to remember all these things. But essentially, under current law, you can't deduct things like rent, wages, marketing, overhead. So for a lot of retailers, that can result in effective tax rates that could be up in the 70% or greater percentage of their income, right? Numbers like that, even in excess of their income, right? There just is no way to make it go because they lose so many deductions. Now, a Schedule 3, if it gets rescheduled to Schedule 3, then marijuana moves there, and 280E, remember, only applies to things in Schedules 1 and 2. Selling of marijuana will still be technically illegal, right? What's going on there in the state cannabis, dispensaries is technically federally illegal, would still be. It wouldn't be automatically made not illegal. It's just going to be a controlled substance, right? That's on Schedule 3. Now, the Department of Justice in its 2024 proposal confirmed that if the rescheduling goes through, 280 Cap E would cease to apply to these businesses under federal tax law. So there is no longer going to be a statutory bar to claiming the deductions per the Department of Justice in their analysis of the 2024 proposal. And nothing's been suggested so far that the interpretation is changed. And I think it'd be very, very difficult to change the interpretation because, as we've been told by the court many times, Supreme Court many times, if the plain black letter language of the law tells us the answer, that's the answer. And the law says you got to be in Schedule 1 or Schedule 2. You're in Schedule 3, you're not in 1, not in 2. Very difficult to see how you could argue without congressional action that somehow these deductions would still be barred. So effectively, these businesses we treated like any other taxpayer under Section 162 of the code, which would be helpful. That said, there's still going to be, though, a number of unanswered questions, so keep this in mind. One thing, a lot of people jumped the gun a year ago and started filing amended returns claiming refunds for prior years. As of the moment, the IRS has told you, I basically put publications on their website saying, don't do this. There is no justification currently for a refund. There may be some justification for doing a protective claim until we see when the IRS says the 280 cap E date actually takes effect. My own guess is, unless they want to be really generous, I suspect that 280 cap E will be a hard cutoff based on the date it moves from Schedule 2 to from Schedule 1 to Schedule 3. Whatever that date is for rescheduling, expenses essentially incurred, or if your cash basis paid, on or after that date are probably what you're going to deduct, and anything incurred or paid before that date. Now, some people are thinking, well, maybe they'll say it'll be the tax year, which I could see doing is simplifying. Say, hey, look, the first tax year you have that starts, let's say, or ends after this rescheduling comes into play, that tax year as a whole would be considered to be under 280 cap E. But we don't know, and that's probably the issue right now. Protective claims are probably okay, but don't expect them to work. By that I mean, I don't really see the IRS going back and say, yeah, because it's been rescheduled now, we're going to go ahead and say for every open year, you can go ahead and claim these deductions. It would be nice, but I just don't expect it to happen. So ultimately, tell clients, if you have clients in this industry, that's good news for the deductions. The Department of Justice also knows to be unique economic impacts on the industry as it normalizes. So you got to be ready to adjust to those. And you also are going to have to realize that estimated tax payments, would need to be adjusted once the rule is finalized. So keep all of that in mind. Next up, we have the IRS deciding that the states told them they needed more time. So we're going to see Notice 2026-6. Yes, we're already into 2026 notices. That happens because it's based on publication of the Internal Revenue Bulletin, which is why even though this notice came out December 19th of 2025, it's going to have a 2026 date because it will not appear in the Internal Revenue Bulletin until 2026 publication date. And this relates to state-paid family and medical leave programs that a few states have. So what we're going to be doing is extending some, but not all, of the non-enforcement period for various tax provisions found in the earlier guidance through 2026. Now, as I said, the big thing to note there is some, but not all. So if you're affected by this, pay close attention to what you can still ignore for 26 and what you're going to have to start actually paying attention to for 26, right? Because this is key, right? So it provides some breathing room for certain items under state-paid family and medical leave programs, right? So this all starts with a revenue ruling that was issued just over a year ago. On January 15th of 2025, we have Revenue Ruling 2025-4 that was issued. This ruling is a reaction to that ruling. Now, that early 2025 ruling held that benefits funded by employer contributions to these programs are taxable gross income under IRC Section 105 and are considered wages for FICA and FUTA purposes. It also classified these as a third-party payments of sick pay, which triggered complex withholding and reporting requirements for the states under Treasury Reg Section 32.1, which is a really odd reference, but we'll talk about that in a second. And also under Internal Revenue Code Section 34020. Okay. Now, the states just told the IRS we're not ready. They told the IRS they couldn't update their systems or budgets fast enough to meet the original deadlines. So what the IRS has decided to do is granted a 2026 as an additional transition period where they will essentially hold off on enforcement because the states couldn't comply with Treasury Reg 32.1. Now you might say that sounds like a weird reg. 32.1, isn't there like a dash somewhere in here? Or now, what it does, it deals with Social Security taxes with respect to payments on account of sickness or accident disability. It's a temporary reg that's been around forever because there was a time period, especially just, I think we finally ended it just a few years after the Tax Reform Act of 86 came out. But you got old enough one, and this is a 1981 law change, which is Public Law 97-123, which amended the definition of wages for FICA purposes to include certain sick pay. So it's a 1981 law, temporary reg issued. Because it predates the 10-year, the temporary regs can't last for more than 10 years, it's never been touched. Because the IRS knows if they touch it, they're going to have to issue a final reg under this and go through the whole exposure and all that other period that they don't want to do. So simpler to just leave it there as temporary forever. Now, let's talk about this. This applies to medical leave benefits paid in 2026, the new ruling. States and employers don't have to follow the third-party sick pay reporting rules generally. We're going to get to a big exception, but we'll get there. Now, what that means is we're going to waive penalties under 6721, which relates to failure to file correct information returns with the taxing agency, and 6722, which is failure to provide a proper payee statement. So basically both the employer and the employee version of the W-2s, right? One goes to the employee. There's a penalty for not giving that to the employee. There's also a penalty for not giving it to Social Security. We're going to waive those penalties again for 26, as long as it's an item covered by this waiver. We need to be very careful because we're going to kind of have to watch the scope in this area as to where we're going to get it. But certainly for income tax payers, no withholding, no payments like that. And for FICA and FUTA, which again is under, Section 32 or Reg 32.1 for FICA, IRC Section 3306 for FUTA, there's no requirement to withhold or pay taxes on these benefits during 26. So what's happening is the state said, hey, we just can't get this done. We won't be able to do this in 26. We need more time. They've been given another year to get this done. Now, that said, they did not pause everything. So there is a big trap if you read this and go, oh, I can just ignore all of this. If you represent employers, you really can't do this, right? It explicitly excludes employer pickups, right? These are the amount that the employer decides, because in some states, you've got a portion that's supposed to be withheld from the employee's pay and a portion the employer is supposed to pay, kind of like the way FICA works at the federal level. Well, some employers are picking up the amount the employee should pay. They're just going to pay for everything. And the ruling provided that if the employer picks up the amount the employee should pay, then that's going to be taxable income, right? Now, there was that third component, the relief that said we're going to ignore that rule for 25. That rule is not going to be ignored for 26. These amounts, anything on the pickup, the amount the employer pays as a pickup, is considered wages to the employee in 26. You've got to start picking those up, and your payroll has to look for that. This was not extended by this new ruling, right? So effective January 1st, 2026, any employer pickups, the amount the employer pays, it was supposed to be taken out of the employee's wages, but the employer decides to cover it, that's got to be reported as taxable wages to the employee, and it'll be treated as a payment of state income taxes then by the employee, right? And so they may get a deduction under the $40,000, or it'd be $40,400 for 2026 limitation, but that's totally separate and not the employer's concern. These payments can be subjected to FICA, FUTA, and income tax withholding. They've got to be reported on the W-2 issued by the employer. So if you have any clients in states that have these programs where there is an employee share and the employer is paying it, you need to tell them to update their payroll systems now to start picking that up, because again, we are heading into 2026 this week. That means hey, Happy New Year, and we got to start reporting this on January. We got to start picking this up on January 1st because this will now become taxable wages if you're in a pickup situation. Next up, a nice little correction of a law quirk that the IRS has administratively fixed for Congress. So this is Notice 2026-3 issued on December the 22nd. It's estimated tax relief for qualified farmland sales, a provision added by the One Big Beautiful Bill Act, right? The problem is there's a conflict between new Section 1062's deferral and the penalties for underpayment of taxes under Section 6654 and 6655. So we have to kind of run with this to try to figure out how can we resolve this problem? Because as we'll discuss, technically, while you get this rule that says, oh, you don't have to pay the tax, you can spread it over 4 years, you still have to pay the penalties as if you had to pay the whole tax this year, which is, yeah, okay, we'll get how that works, right? So again, new Section 1062 allowed farmers to defer tax on the sales of qualified farmland property. That meant what it was, and it's very, very similar to what we see when we talk about the LIFO recapture when you make an S election with a C Corp. If you ever had to gone through that, which probably most of you haven't, but if you did, there's a quirky rule that says if you do that, you make a S election for a C Corp that's been using LIFO inventory, that in the year of the election, the final C year, you have to essentially pick up, restate the inventory back to essentially a FIFO structure initially, and then you'll use LIFO going forward, but you're going to get rid of the layers. The C layers have to disappear. And so what's going to happen here is you pick that up as income, but because they realize that's going to be a big chunk of income, they said what you do is you go back, you do a with and without calculation, compute how much you're paying on the LIFO recap you're required to pick up. And then you pay 1/4 of that with the final C return. And then you pay an equal balance with each of the next 3 S returns. Okay, we're going to apply the same concept, but now to non-C Corp returns, right? To anybody who qualifies qualified farmland, right? So again, before liabilities, again, compute with the sale of the qualified farmland, compute without. That tells you how much tax you're paying on the sale of qualified farmland. Divide that number by 4. Pay 1/4 of it with your return this year for 25, assuming you sold it in 25. And then you pay the other 3/4 equally over the next 3 years, 26, 27, 28. Okay? That's how it would work. But there's a problem. There are some quirks. First thing is not easy to get this. So just in case you weren't deep in it, you go, hey, that sounds good. My client sold some farmland. Okay, we do have some requirements here, right? It has to be farmland, U.S. land used for farming for substantially all of the 10 years prior to sale. Substantially all is something that we find weirdly defined in the code, but talked about a couple of times related to other topics. It tends to be in at least 80% and quite often in the mid 90s, so 95% or 90% usage. So, of the time it was there, it had to be used for farming for, let's say, at least 95%. Whatever percentage we work on, there will be there. The other catch is it must also be sold to a qualified farmer, and the sale has to go with a covenant prohibiting non-farm use for the first 10 years after the sale of the property. So you have to have that covenant there. It's got to be legally enforceable restrictions prohibiting non-farm use. You can't just sell it, everybody going wink, wink. Yeah, we all know right away this could be transferred from this farmer, the second farmer, to a developer who's going to basically take out all the farmland, and use that, for a brand new development. Now, that doesn't work. You got to have it tied down in a restriction, a covenant, which, by the way, will have to be submitted with the return for the taxpayer who is claiming, the right to defer those payments over the 4 years. That is a key requirement that's in there. Now, what's the problem then? I mean, okay, we've got this. You pay it over 4 years, seems fine. The problem is, the estimated tax penalties. Under 6654, 6655, those penalties are based on the tax shown on the return. Mechanically, even though Section 1062 defers payment, the total tax liability is still shown on the return. Then you basically get to subtract out that I still need to pay this year. You get to pay over the next, 3 years. So without relief, you would have to pay the full estimated tax this year to avoid penalties, the full amount of tax to avoid estimated tax penalties, and then you'd get just a whopping refund that you pay in over 3 years, which would be kind of dumb. It would totally defeat this whole issue of giving us a 4-year installment plan, right? You're going to pay it all together. Then the government's going to send it back to you once you get the return filed. Then you're going to send it back to the government. It's like that. That's absurd, right? So, and it really screws up the cash flow benefits, right? Theoretically, the reason to do this is, to give the seller a better cash flow going forward. But it's not much better cash flow if I've got to go ahead and get those estimates paid and treat that as a 25 tax. It was last year. So we're going to go ahead and switch it over and try to go ahead and just, not defeat the whole purpose of being able to pay this 4 years on installments. So what did the IRS do? Notice 26-3 is, in essence, the IRS's correction. It allows the taxpayer to exclude 75% of the tax liabilities related to the sale from their required annual payment calculation. Now, you still got to include the 25% that's actually due this year. So let's say there was a, $100,000 of tax due on the sale of qualified farmland. You'd be able to only pay $25,000 this year, but that $25,000 doesn't go into your underpayment of taxes calculation, right? So essentially, the remaining 25% still included. We'll go ahead and we'll pick up the other 25% will be added to future years. Presumably under this structure, we're going to do the calculation, okay? So theoretically, it's essentially a 4-year installment payment plan, right? The IRS is essentially lending you the money, interest-free, right? And deciding that, we're going to go ahead and, let you pay us over time. Now, normally, if they were lending, and yes, you get installment agreements, right? If you don't pay all your taxes, but normally they're going to charge you for not having paid on time, including estimated tax payments and, the estimated tax penalties, among other penalties, where it's going to kind of like say, we ignore those future payments, only look to the down payment when deciding if you're good for it, right? We don't have to go and pay under other interest rules and things like that. So essentially, we're looking at just the down payment, the 25%, to see if we had enough paid in. We don't need to pay in everything. And that's kind of the issues. Now, key issues. If this applies to your client, you got to make sure you do the election right, because it's got to be a valid election. It's got to be with the return, right? So it's due by the due date of the return for the year of sale, right? It's got to attach a copy of the covenant and restriction has to be attached to the return, right? If you this issue is if your return's compliant and you don't self-report the penalty, the IRS systems are supposed to handle this automatically. Now, we know with this year what it's supposed to do and what it will do. Even if we hadn't had a bit of a time period there where we had, about half the IRS missing or more than half missing, without that, this would have been a challenging tax season. So what happens if you still get a penalty notice? Well, if you receive the notice, then you essentially file Form 843, right? That's your claim for refund and request for abatement. Right? And you do have to, and what they tell you to do in the notice, you have to put the top of the 843 abatement request pursuant to notice 2026-3 at the top of the return to assure it gets processed correctly. Again, I expect we will see if you have a client who did this year, I would not be shocked to see the penalties get computed. Maybe they'll do something with estimated tax form. Maybe they'll have some way of flagging it better, but I just don't see it quietly being done properly if you attach the election. I see all kinds of issues there. So be ready with the relief procedure to warn clients that, this year we expect to be bumpy. This is new. This is the kind of thing, and they just added the relief late in the game. So this is where we could have issues. Next up, we have a couple of FAQs, or basically updates to fact sheets, actually, to close out this week and to close out most of the year. The first one's going to be on fact sheet 2020-509, issued on December 23rd, and it updates you on the investment interest limitation changes that took place. Right. So this is guidance on the One Big Beautiful Bill's changes to 163J, the business interest rules, right? And as I said, issued on the 23rd, just before Christmas Eve. So our little Christmas present, shall we say, in this case. Now, a couple of things going to note there. And this whole series of questions, we're not going to go through all of them. You will note if you grab the fact sheet, and we do have a link to it on the Current Federal Tax Development's webpage in the article on this, or if you download the PDF, we should have a link to it in the PDF that will let you read this, and it is a PDF document itself, will let you read this particular notice. And you'll note that it flags the ones that were changed in this change, right? It has December 20th change date for the various paragraphs that were changed, that it's updating stuff. One thing which it does do, which really wouldn't have mattered either way. I mean, you'd had to change this either way, whatever the dates were. Our inflation adjusted gross receipts amount. Remember, there's a small business test where you can get out of 163J if you have average gross receipts for the prior 3 years below a certain number. For 2025, that number will be $31 million, right? So average annual gross receipts, $31 million. That's the test. It's the same test used for small businesses, right? Getting out of 263 Cap A Unicap, basically the small contractor rules, the various things and the special inventory rules. That's the same number. We always use that, right? Now, they do clarify that if 2024 did have disallowed interest because you weren't exempt in 24, but for 25, your gross receipts are less than 31 million, then when you get a 25, you pass the test, you're a qualified small business, you don't need to use 163J, you will get to deduct both the disallowed interest you carried into 25 along with the interest you incur in 25, right? Neither the carry forward nor the 25 interest is going to be subject to any limitation on deduction, right? Or at least under 163J, no limitation on deduction. Also, there's a reminder that we are going back to calculating under the earnings before interest, taxes, depreciation, amortization, and depletion for the adjusted taxable income. ATI is bigger. Because we're adding those back, that's a larger ATI. That means the cap on interest will go up automatically. So we should be able to get larger interest deductions. Again, this fix was not retroactive. So 22, 23, and 24 are still going to be stuck at the old levels. A year ago, they tried to pass a retroactive fix to this. That stalled in the Senate, never went anywhere. So we do get relief for 25, but we don't get relief in the past. Now, a bit of bad news, if you have a controlled foreign corporation, this again will be for next year. In 26, you have to exclude controlled foreign corporation income, inclusions like subpart F and GILTI, or whatever the heck we're calling GILTI these days, from the adjusted taxable income. That would shrink the adjustable taxable income base. So that could tighten the interest deductions for companies that have these inclusions. So if you have that, multinationals potentially would have a tighter income cap. So be aware of that, right? Also, we have a change to floor plan financing rules, right? Floor plan interest is 100% deductible. The definition of what is a motor vehicle, because it has to be a floor plan on a motor vehicle, that is being expanded for 25 and later years. It now covers trailers and campers designed for living quarters. So RV dealers that were in a gray area or excluded now will be clearly in. Now, it's not totally a win because there are some quirks about using the floor plan interest rules, including the fact that you get stuck with no bonus depreciation in a year in which you had to take advantage of the floor plan interest exception to be able to deduct some of your interest. If you didn't need it, it doesn't restrict it, but if you need it, it's got to. So we have that there. So if you've got an RV dealer who previously had not been treating anything as floor plan interest, you do need to go back and kind of review the rules and how that works. You haven't been working with this before. There also are changes to capitalization rules that begin next year. So the ordering rules are going to flip. 163J will apply before capitalization rules, but not all of them. This gets a little weird. So mechanically, you're going to calculate the interest limitation first. If the interest is disallowed in 163J, right? you don't even get the question of capitalizing it in inventory or assets. It simply gets the capitalized part goes first. Automatically, capitalized part will basically reduce your 163J deduction, but it doesn't include capitalizations under Section 263G or 263 Cap A F. So unicap rules there, and a special rule under 263G. So those don't count. I think the unicap would be the big one, but we're there. Also, post 2025, its interest is line carried forward. It's never treated as interest subject to capitalization in future years. That's true about the carry forwards triggered. Potentially you might get a 163J limit, and the amount you got to capitalize this year is more than you're allowed. That disallowed amount that couldn't be capitalized in basically it couldn't be capitalized in 26. When it goes to 27, right? It simply becomes business interest and does not need to be capitalized in 26 or later. It will simply be applied to 163J test, and once it's released under that test, we get a deduction for it. Our second fact sheet also came out on 23rd, though this one was not considered a Christmas present by many, we'll say, is fact sheet 2025-10, December 23rd, 2025. Talks about the premium tax credit and what's different for this year. So we're going to talk about the expiration of the temporary relief provisions and some new affordability metrics to come into place this year, right? So it's mainly going to cover the big thing that's going to be approached here. It does deal with some other changes, but the big thing here is the sunset of pandemic era relief for the premium tax credit. If you're not aware, you haven't been paying attention, you thought, oh, they're going to solve all this. By the end of December, we'll have something. No. They're still talking. So any fix would have to be retroactive in some way, shape, or form. I'm not sure with the way with the marketplace insurance and how that's structured, how in the world will it ever get that fixed? But nevertheless, whatever it is, we're going to go ahead and be able to move forward. We'll just have to see how that goes. Not getting it. If you're going to do something, not getting it done by December opens up a whole Pandora's box of problems that I'm not sure a lot of Congress understands the Pandora's box they open. At this point, trying to change it after January 1st becomes way more complicated. Okay, so first thing is, as we know, we have caps that expired after 2025, right? We went back to the old Affordable Care Act limits, which I find sometimes people kind of forget that we're just going back to what was before. So to be fair, that is what we're doing. We're going back to what was there. So they greatly expanded the premium tax credit program during the pandemic, and they ran it through the end of 25. There was a 1-year short fix, and then we got, an extended version, took it all the way out to 25. Now, as I told people at the time, I was pretty sure that was a gamble by the Democrats, that in case the Republicans needed their votes, right, to extend all the things that were ending that they desperately wanted to continue in 25, that this would be the thing they would be able to kind of force them to accept. Obviously, push came to shove. The 2024 elections came by, and the Republicans got control of the House, Senate, and White House with that trifecta. As long as you can do something through reconciliation, you don't need the other party. So, it really didn't work out in that fashion. So it expired, but now it's becoming a big issue because, it's tough, let's say, to see how the voting's going. There are certainly a number of divisions, shall we say, that are showing up in the House especially. And we know that there is a discharge petition that will apparently force a floor vote on extending these, on extending these particular, higher level credit benefits. So it's going to get messy over the next month. We'll just phrase it that way. Yep. So we apparently do have another discharge vote coming. This is getting interesting and why it is so difficult to govern in the House if you have a very narrow majority, especially if the other party stays united on a topic. You just need a couple of defectors and we're voting on it, which is what's happening. That's where we stand right now. Now, under the ACA, there was a cliff. Once your income, your household income, went to be basically 400% of the federal poverty level or more, you couldn't get a credit. It was a hard cliff in the Affordable Care Act. Now, what we got during the pandemic was we removed that hard floor. As long as your amount you had to pay, for the second highest cost silver plan or second lowest cost silver plan, uh, was more than 40%, was basically, it was more than the required percentage of your household income, you could get the credit even if your household income was more than 400% of the federal poverty level. So there was no hard and fast cutoff. You remember the hard and fast cutoff, you could go from a still relatively significant credit to zero with $1 extra income. So yeah, it was a problem. We saw clients who were making, let's say, IRA contributions. They could make a deductible IRA contribution. They'd make an IRA contribution of a minimal amount, and it would give them back way more. It's like keeping them paying way more money. It's just weird. We're back to that officially for 26, not for 25. This is 26. But again, premiums are being paid this week, generally, for the first month of 26. So yeah, we're there for 26. So this is for people who are getting their insurance through the exchange. This is their primary concern date, shall we say? Right. So under the under the interim rules, right, there was no repayment, right? And there was a cap on how much excess credit you had to pay back. If house income was under 4% for a poverty level, there was a cap of how much you had to pay back. Following 2025, if the client receives too much advance credit, they have to pay the entire excess amount dollar for dollar, period. There is no cap on payback. So whatever you should have got as your credit, whatever we compute you get as your credit at the end of the year, if you got more than that in advance credit, you're paying the whole thing back. That was not true before. Right? That's something to realize. The subsidy cliff has returned. For 2021 through 2025, we didn't have the cliff. You could still get the credits if premiums were high enough. After 2025, if your income goes over the 400% of the poverty line, the eligibility drops to zero. Full repayment of every dollar you receive during the year is what's required. Now, hopefully your clients, and you might want to scan your clients, because some clients are known to just go into the exchange and just kind of play the game of just, tell them whatever, get the credit, and go from there, not worry about it. You got to tell clients who are anywhere near 400% of the federal poverty line that they're facing a cliff if they go over the top by even $1. So they need to be very careful, right? You can go from, yes, you qualify for this, to you qualify for nothing. And they need to be aware of that rather than find out about it next April. So I would probably warn anybody that you compute, who got a subsidy in 25, right? That in 26, they have to worry about the full payback rules back again. And therefore, if their household income goes above that limit, we have a potential big problem. Not minor, big problem, right? Now, we also have the affordability percentages are updated every year. So I've got this in here. So the affordability percentage for employer plans is 9.02% for 25. Remember, you cannot qualify for a credit on the exchange unless if you were eligible for employer coverage and the employer coverage was affordable. Affordable will be 9.02%, right, of your household income for 2025 returns. For 26, that will rise to 9.96%. Just under 10% of household income is what you have to be willing to devote to the medical coverage before you can be eligible to get a premium tax credit. If your contributions exceed these percentage of household income, so you look at the employer plan, what they would have required you to have paid is greater than 9.96% of household income. I should say 9.02% for 25. Then you met the safe harbor. So we don't worry about the employers not kicking you out. Now we look to whether or not, you've been kicked out because of, other rules, right? In essence, you have too much income in general, et cetera, but you're not out of there due to affordability. Right. Now, the household income definition, household income is very broad. It is modified adjusted gross income of the taxpayers and every member of their family that has a filing requirement. And this is a backdoor way you can get into trouble. Because if somebody suddenly gets $1 over and has a filing requirement, you're going to add a few thousand quite often to household income. And that could be enough to cause a problem, right? Now, modified AGI for this purpose is not the one we've been talking about all the time for the One Big Beautiful Bill Act, which was always AGI plus foreign income exclusion, plus foreign housing exclusion, plus the territorial income exclusion. Now, modified AGI has different meanings. In this case, what you add to the AGI of each taxpayer is the foreign income exclusion, right? 9/11. Exclusions for foreign income are 9/11. You add back non-taxable Social Security benefits and Tier 1 Railroad Retirement Act benefits are added back. Non-taxable Social Security Railroad Retirement Tax Act, non-taxables, plus tax-exempt interest. That's the three things you add together. And you do that for every member of the family, right? You got to make sure those three are added back, because if you fail to do them, then you may suddenly have a surprise on the return. That they're there. People think, oh, I get my household income down by swapping over to tax-exempt interest. It's not going to work for this, right? It doesn't. Also remember, if an advance credit is received in any amount, a taxpayer absolutely must file Form 8962 for reconciliation, right? Any APTC was received, you've got to file this form. If you skip this to avoid a repayment, you're not going to be able to basically receive advance credit in future years. So you want to make sure you file the Form 8962. Failure to do that will block advance payments in future years. That's kind of a problem, right? Finally, there's specific safe harbor where the marketplace or tax return disagree. If the marketplace estimated the client's income be low enough, this rule's been around for a while, that the employer coverage was unaffordable, they grant the credit. If the client actually earns more, making the employer plan technically affordable. Now, this doesn't save you for the fact that your income, right? You still got to pay that same percent of your income in to be affordable, right? Under the basic rules. But if the marketplace screwed that up, right? Because again, if you have affordable employer coverage, it doesn't matter. So, but if you actually earned enough income that now it was affordable coverage to you, which remember is one of the two tests we work about here, then the safe harbor protects the client's eligibility for premium tax credit, providing they didn't lie to the marketplace. And this is a concern that it's considered if you had reckless disregard for the facts, then this protection doesn't work. But there is that out. So remember that if somebody gets a notice back, we may need to go back and see if we qualify for the safe harbor, right? If the marketplace just determined that it was affordable, then we're there. And the reason for that is because usually affordable is really going to be calculated when they get the report from the employer and they compare the reporting form the employer sent them and what was offered to the employee. They compare that, and that's how that'll go, whether it's affordable or not. So you're getting out on affordable for purposes of the disqualification because you had basically had an affordable coverage offered to you by the employer, but that won't give you an out for the rest of the stuff. So it's a weird exception, but sometimes it matters. So, ladies and gentlemen, we are heading to the end of the tax planning season, right? The clock runs down on tax planning at 11:59 p.m. That's the last instant on December 31st that you can do most tax planning, right? And we'll have a few weeks then we can kind of breathe, not worry about answering the phone. Always worry about that on December 31st, right? And, answer the phone just before you're closing the office. And then some client has some things like, oh, we got to act right now to get it done. It's like, yeah. No, we don't have that. We get rid of that. Midnight rings on December 31st. If the client calls you then on basically the first day back at the office, it's like, well, great, but you waited too long to get a hold of me, right? You can't do anything about that now. So that's kind of the key issues here. So what are some of the big timeline items we had today? We talked about this week. You want to prepare clients for the potential, basically sunset of the 280 cap E, depreciate, basically the cannabis rules if you got them. We also have the state relief for paid family medical leave. If you're involved in that, you deal with that. Remember, we've got relief for everything except employer pickups. So employer pickups, be sure there. Remember the agricultural tax. If you have anybody who's sold qualified farmland under this rule, probably not a whole lot of you do, but probably a few people did it this year. We do have estimated tax waiver that you want to read over. And then you want to be very careful following guidance on all the forms this year to make sure if there's some way to flag that on the, let's say, the estimated tax form, that we flag it properly, right? Remember that, don't forget 163J, we did change our calculation this year, and we have new capitalization ordering beginning next year. And then don't forget about the changes to premium tax credits. That one you're just going to have to watch, see what Congress does. But you may need to explain to clients if nothing happens, everything just stalls out, which is a very real possibility. If everything just stalls out, you got to warn those clients could be impacted about the fact that get ready next, if you're taking the credit, the advanced premium credit payments this year, even at a lower number, you may still be at risk of paying the whole thing back. So you want to be aware of all those protections you've had the last few years, that made it less of a risk to claim to get the advanced premium tax credit. And remind a client that this might just be borrowed money. So, keep your eyes on that. This has been the current federal tax developments for the week of December 29, 2025. My email address is edzollers@currentfederaltaxdevelopments.com. If you have a quick question, you can email me there. I also do keep up with the Connect postings on a number of state society sites. Arizona Society of CPAs, obviously I'm in Phoenix, but also New Jersey, Idaho, Minnesota, Illinois, and Washington. So if you have a question, you can post it there and see, I'll see if I can respond to it. Otherwise, hoping you're going to have a happy new year and have a good time. Don't party too hard. Although apparently, if you're not going to be in the office on Friday, you've got a few days to recover from whatever partying you do. So I guess you could party harder this year. It's not as if you're going to be, are you going to be that CPA who decides tax season starts right after the 1st of January? Be down at the office at 8 a.m. on basically Friday. If so, hi, you'll be there. I'm down here recording on Saturday though, which is weird. I'm down at the office today. Had to come down and do a couple of things with the computer, so I'm here. And I think there's one other person in the entire building here in this office building, because I saw one other car in the parking lot. I kind of glanced him, looking through. I could kind of see him see a car on the other side. So I think there are two of us here in the building today, which considering the size of the building is kind of interesting. There's only two people in it. Yeah, but yeah, it is, basically the Saturday after Christmas. So I kind of understand why there's not a big crowd down here. So otherwise, we will see you next week when I may be down here the Saturday after New Year's, seeing if anything else goes weird to the computers. Yeah, the computers had a glitch for remote access that happened like an hour after I left. After I left on Christmas Eve. It's like, oh, good. I'll get back down eventually before somebody shows up Monday morning and wonders why things aren't quite right. Everything's back and right, but yeah, just that weird setup. So otherwise, we will see you next week here on current federal tax developments.